Well, welcome to the June 2023 edition of the ASIS Economist Board. I'm John Nelson with M&A, and I'm joined today by Keith Prather of Armada. How you doing today, Keith?
I'm doing good. I'm doing good. We were joking off camera about the fact that we coordinated today color-wise. Didn't mean to do that, but hey, we'll take it.
Not a lot of creativity on this Monday morning or Friday morning.
Not when you're talking to data analysts or economists, right?
That's right. That's right. Okay, so what we're going to do is we're going to take a look at our first video that cover industrial production at the top level. We'll also take a look at fabricated metals and primary metals within that as key supply drivers. And then we're going to take a look at all of the major subsectors of industrial production. We're going to take a look at what's driving each one of those forecasting models. Important to note, Keith always likes to remind me to tell folks that we're looking at a whole lot of different variables, about 18 to 20 different economic indices to come up with these individual models with our data going back about 20 years. So there's a lot of analytics to go into it, and in the black box of the ASIS, so to speak. So it's an interesting time in both manufacturing and the broader economy, isn't it, Keith?
Yeah, absolutely. We've got a lot of weird cross currents still. And we got a brand new bunch of global data that we're going to talk about as we go through the recordings and everything. So we'll hit those highlights and kind of give you a feel for what's going on a global basis as well. So
okay, well, let's stop boring the viewers with two monkeys talking. Let's start looking at some of the models with their wanting to see. So I'm going to make sure I have. There we go. We got to get them up to the right spot, and we'll go ahead and take a look at industrial production for manufacturing. And this model, much like so many of the other models, is pretty much the same story as months before. Some slight variations, but you'd expect that as new data comes in. But we have what we didn't see previously is a little bit of a jump here for the next month or so. I wouldn't get overly concerned about that. What I would focus on, though, is the trend. That's what we always like to focus everybody on. And if you take a look at the trend for the next few months, it looks exactly as we were calling it with the April data. The May data is kind of saying the same thing. As we move into the fall, it's just going to kind of start a slow dive off. And but a little bit recessionary is like the way you like to talk about it, Keith. So I'll shut up and let you take over on that.
yeah, no, I mean, I think those are great insights in this particular model. I mean, you and I have been pretty satisfied with it. I'm just looking here, we're still performing almost 99% accurate 3 months out. So that little dip that it's showing looks like it's gonna, we can kind of count on that little surge. And then 6 months out, we're right at about 94%. So still some confidence even as we get out into the end of the year. But the two things I saw, as you said, I mean, it was really that next 2 to 3 month kind of increase in manufacturing, which is interesting because we're not necessarily seeing that in some of the surveys that we see on a monthly basis. But as we go throughout all of these models and we talk about the individual sectors, there's a lot of individual sectors in here in which manufacturing is still booming and doing very, very well. Mm-hmm. You and I've got a lot of anecdotes we're going to talk about throughout about individuals we've talked to that are talking about, they've got production facilities running as fast as they can run, still can't meet demand, still have supply chains that are challenged. And so that's kind of a backdrop as to some of what's going on. But also notice that in 2024, you look at the back end of that curve, kind of getting into the late part of 24, and it's starting to show, kind of a bottoming effect. And we see that across a lot of other industries as well, where, maybe before in prior months, we never really saw the end of that decline and the overall recession, if you will, for these sectors. But now we're at least showing a bottoming process and then maybe a little bit of a recovery process. Yeah, right on that tail end. And so that's positive. So the models are starting to pick up some changes either in supply chain continuity, meaning products are available and ready when the demand is there, and then also a little improvement maybe in the back end of the demand curve and showing a little stronger consumption, a little stronger demand on the backside of this. So we don't have any, federal interest rate projections or anything like that built into these models. But it is kind of interesting that the 18 to 22 factors that you did talk about, John, that go into building these are picking up something that would kind of give the Fed a little more encouragement when, maybe see some rate, some declines in at least the overall interest rates,
Sure.
sometime in 2024, which eases the market up, improves liquidity a little bit. And so then the models would react to that improvement in liquidity. So that's a little of what it's seeing, at least. And then I think on the next slide, we can kind of put it in perspective. Yeah. So overall, I don't know if you want to touch on this a little bit before I dive in, but
Yeah, it's a drop. Yeah,
yeah,
it definitely takes you below that 20-year trend. And we oftentimes talk about the 10-year versus the 20-year trend. This is one of those cases where the 10-year trend looks a lot like the 20-year trend line, real similar. But so the depth of this drop is pretty significant. It's 7 percentage points drops over the next several months. And it's and we'll talk about this in one of the other sectors. It's not quite as rough as the COVID drop, but still it's a pretty significant drop. Nor is it as bad as the recessionary drop back in 2008, but it's still a significant drop. We haven't seen a drop like that other than the recession and COVID. We haven't seen another drop this severe.
yeah. So this is a good time to talk about, we just got 28 different countries reporting manufacturing activity for May. And there were some big themes that came out of that. I mean, number one, most of them have cleared a lot of their backlogs. There's still some industries where we have backlogs. You and I were talking off camera that some of the electrical components and electrical supplies in the construction sector are backlogged and backordered, maybe up to 18 months. Aerospace, automotive, some pockets of machinery like in ag machinery, some pockets of recreation, some power sports, motorcycles, some of those industries still seeing problems getting their supply chains back to a point where they can crank off units off the assembly line as fast as they want to, or as fast as demand is dictating. So there's still a little bit of backlog, but generally when you look globally, the supply chains are somewhat fixed at a macro level.
Mm-hmm.
And so we're reading that. And so input prices are starting to come down a little bit. We're starting to see manufacturers having to discount prices on the front end then as they sell those products. And so we think maybe inflation is going to start to ease a little bit on a global basis. But new order demand was really stark. We saw generally across Europe a plummet in new order demand. And many countries in Europe, effectively, when you look at their purchasing manufacturing indexes, their PMIs, effectively in recession. So a lot of those readings came in the low 40s. A reading of 50 is considered to be that midpoint between expansion and contraction. And a lot of them, once they get below 45 in the manufacturing sector, it typically signals that broader economy is also in recession. So the US right now is hovering around 48. It did dip back into contraction in the US. So the manufacturing sector contracting a little bit, but not at recessionary levels. And that's kind of what the models are starting to hint at. Although right now in our model, we're showing a little bit of a contra effect. We're predicting that over the next couple months, as you said, John, we're going to get some good news. You're going to start to see that, this manufacturing activity is going to inch up a little bit before it then goes ahead and tips over and takes the dive. Last little thing I'll add about this is that one of the underlying fundamentals, and we see in the inventory data, is that about 64% of the goods moving industry in the United States is overstocked relative to where it was in the 10 years prior to the pandemic. So when you go look at it that period and you think about a lot of purchasing managers sitting on inventories, whether they're retailers or whether they're manufacturers or wholesalers, and they're looking ahead and they're feeling a little bit of this recession risk, they're a little worried about the consumers, they're worried about the banking industry, they're worried about a lot of different facets of the overall economy. They're nervous enough that they're not ordering new products. And we saw that again across those 28 different countrywide manufacturing reports we got in May. New orders are down. And that kind of signals sort of what's coming forward. And I think, John, we were predicting it. We've been showing this negative curve now for several months. So we knew it was coming. We just didn't know maybe how fast it would hit or how hard it would hit. And the models now, when we see this consistency month over month, we now can kind of feel confident again when, especially in a model like this that's performing at 94% accuracy over 6 months, that we're getting to that point now where this downturn feels real, and bloated inventories coupled with a little bit of weaker demand is really what's kind of choking the cycle off.
Gotcha. Well, you've been talking a lot about supply chain. Let's take a look little bit back at that supply chain. Let's go taking a look all the way back at the beginning in the primary metal, and here you're seeing kind of reflective of IP Man itself, where you have a little bit of a rise here for the next couple months, but then a significant trail off, and actually quite a bit of a trail off, almost 20 points for the next several months. Flattens out a little bit at the bottom, but again, this is not a different story than what we've been telling. It's month after month we've been saying this is what's going to happen, and the models are still bearing it out.
Yeah, and this one has been a volatile model historically, and the fact that it is almost showing us exactly the same curve month after month shows that we're starting to get a little bit of stability in it. And again, it doesn't tell a great story. We can probably jump to the next slide even to show the historic trend, but it's still showing that dip, and this one's even a little more pronounced. It's predicting a little harder fall with the primary metal industry. We saw in some of the PMI, some of the heavy producer markets like China, Taiwan, Japan, you're starting to see some real deceleration in those markets. And typically they would be some of those countries that would be trying to order early on in the supply chain, building primary metal inventories, getting ready for a manufacturing surge, and they're just not getting ready for it. It just doesn't look like they're pre-building going into the peak season to try and build up inventories. And so it really is pushing and forcing this model down. Again, there's a lot of volatility if you don't look at the prediction, but look back historically at that blue curve, and you can see that there's a lot of volatility on a month-over-month basis in this data. And we don't have any reason to believe that won't continue, but the general cycle and direction that we're showing you in these curves show, again, this kind of interesting little 2 to 3 month little pop in the primary metal manufacturing, but then it kind of slips off the cliff and kind of then dives.
Yeah, and if you compare this volatility to the IP Man's a lot flatter, and it doesn't have these swings, and it's it shows that recessionary dip, but not nearly as much relative to this one. Well, this has greater swings and has a greater recessionary dip, so it's bearing out what history has shown us, that the volatility in this is going to be far more pronounced than in IP Man itself.
Yeah, and the last thing I would add here before we move on is we just got some of the labor data out this morning, and it showed that in manufacturing, we've got two different stories. In the durable manufacturing categories, which is what we're measuring through most of our models, the IP Man model we showed you just a minute ago includes both durable and non-durable, but labor and hiring inside the durable category was still growing in May, but the non-durable category was starting to contract. So we saw losses of about 5,000 jobs in the non-durable categories. And so it doesn't have as much of an effect on primary metals, but inside manufacturing, you're starting to see real-time data is starting to show some of this deceleration.
Sure. Well, let's move in a little bit closer. Between primary metals and in industrial production, you're probably going to fabricate some metal. So let's take a look at what that looks like. And again, you're looking at a curve that looks remarkably similar to the last time. We have a little bit of acceleration for the next few months, actually maybe for another month or so longer, but then that trail off, again, reflecting the same kind of pressures that we're seeing on the supply side that are overall influencing the industrial production as a whole.
Yeah, and I think some of the models are starting to bear out a little bit of a trend we're seeing across the economy, where some of these industries that are still struggling to get inventories back where they should be, like let's think about automotive for a minute. We'll talk about that later, but automotive right now, you still see OEMs trying to catch up and get dealer inventories back to a point where a customer can walk onto a dealer lot, find a car that they like, and buy it on the spot and drive it away.
Yeah.
They're not there yet. And so those supply chains are still cranking products, which means fabricated metals, primary metals, some of these other industries we've seen the little pops are being driven by what's happening in automotive and aerospace and some of the industries like agriculture, machinery that are still driving some of this heavy durable construction. But the models are picking up that demand softens, and demand is softening now. So once you kind of recover and get those backlogs completely filled, then you move into a period of weaker demand, which means then the actual production falls off. And that's kind of what the models are showing us now, is they're corroborating what a lot of speculators are kind of forecasting. And so, and again, this is important to reiterate to everybody that we're just letting the analytics do this. We're not, you and I aren't manipulating this. We're not hearing narratives and trying to go out and manipulate the data to try and fit the narrative. It's the other way around. We're looking at the data and what the models are telling us with, and we've come to the point where we are looking at the accuracy on the models. And, this particular one right now is running 98% accurate through 3 months, and about 94% through 6 months. And so, high degree of accuracy here. So we're trying to work it backwards to say, here's what the data is telling us. Here's the story and the picture it's painting. Now let's help go out and explain what it may be looking at, right? So,
absolutely. So, and then if you take a look at long term, what stands out to me, you don't have as volatile of a model as you do with primary metals. It's a little flatter in terms of the monthly swings or the short 3 and 4 month swings. Like primary metals, you still have a gradual decline over the last 20 years. But at the end of this, we are, several points below trend, not as deep as the COVID drop, but definitely in that recessionary area.
Yeah, we just got new construction data out, and manufacturing construction activity in the United States is now approaching 150. It's like $152 billion annually, which is up almost 65% year over year, up 156% over where it was prior to the pandemic. And so we know that this whole reshoring trend is actually real and taking place. And so I think that lifts the fabricated metal industry. But again, as we talked about in the last month, it takes a while for all that construction activity to take place. We've talked about backlogs of different materials. So the projects are again delayed, but then it takes a while for those projects to actually start kicking out product. And so I think long term, I think this is one of those models that will eventually, some industry activity will actually push it higher than maybe what fundamental economic activity is suggesting, right? So the economy is going to generate a certain amount of demand, but the fact that we are winning market share away from global markets and bringing it back to the US fundamentally helps push this up over time. And the model will start showing that in the future. But right now, even though it's a downturn, we don't like what it's showing. It's showing a mild recession. It's still a mild contraction. You're talking about, as you said earlier, John, maybe a drop here of about 8 to 9 points, I think, overall from peak to trough. Whereas you go back to like the financial crisis and there was a drop of 35 points there. So nothing on that scale, but again, it's a slowdown.
It looks remarkably similar to what we saw from 2014 to 2016 in terms of scale.
Yeah, great point.
Even the slope. So it's not out of historical precedent.
Great point. And and actually what's interesting is that period of time also, the US dollar had surged and inventories got bloated in that cycle as well. At the middle and early part of 2014, inventory surged. Took us 2 years to feed off those inventories, and that's what that downturn was. So hopefully it won't take as long this time, but that's kind of what we're working through.
I hope not.
I know, me too.
All right. Well, that concludes our look at industrial production, as well as the key drivers or the key feeders, if you will, in the supply chain, both fabricated and primary metals. Hope you enjoyed it, and we will see you again next month.
Sounds good. Take care, everybody.